Okay, today we're going to spend a few minutes kind of highlight the new crop insurance program. Provides protection to growers for income over feed cost. It's a tool for dairy farmers. It gives them a safety net on their milk prices, keeps the milk price, the ratio between milk and feed into line, and that's why it's called a gross margin as its technical name. First, just to start out basically, the goal of crop insurance is to help a grower survive a disaster and return to profitability. And the idea being that I'll either have my crop or my milk, the income from it, or else I'll have an insurance payment so I can pay the banker. In this particular program, income over feed cost, in a given month, you can look ahead and kind of see what the projections are. This particular month, it looked like when we get down to decision day, the end of the month, the last business Friday and the following Saturday, it looked like we might expect a $12 income over feed cost. So a question to me as a grower is, what is that worth? Is that something that's a meaningful safety net for my operation? And as we look in detail, you can see that, for example, the enrollment period in November, we were looking at the opportunity to lock in the income over feed cost for the period January through October, either any of those months or all of the months, and you can see there's a breakdown there. It runs in the 12s throughout the whole month. That's on a per hundredweight of milk. You also see to the right of that, you see the prices that margin is based on for corn and milk and soybean meal, and the conversion factors that we used for the feed to produce the milk. Now, the grower has the option. He can use the standard USDA conversion factors, or he can use his own actual feed use. We can also look back to the previous month, and for example, in the October, the grower was looking at enrolling for December through September, any of those months, and the income over feed cost projections were from the low 12s to just over 13. And of course, the payment is made when the actual, after we go through those months, is comparing that to the estimate or the expected. And if there's a deficiency, if the actual is less than the expected, then that would be a payment that the grower would receive. Just to give a quick example, the most recent 10-month cycle that was completed, that means the insurance period, the grower in this particular case had the opportunity to enroll in October. First coverage could have gone into effect in December, and it went through September, and I could, as a grower, could choose any or all of these months for one or more hundredweight of my milk. And the green depicts the amount of indemnity per hundredweight that I could have received at zero deductible. And so we have, for example, in February we would have gotten almost $6 less the premium, or about $5 net, and pretty handsome payments out through here. So when you look back at the last year and know how tough it was in the dairy farm, one would ask themselves, what would another $3 to $5 increase per hundredweight have done to my financial situation? That's what the program's all about. Just a simple example how one goes about calculating the income over feed cost. The milk prices are based on the Chicago Mercantile Exchange for Class 3 milk. The feed prices on the Chicago Board of Trade. So when we were calculating the expected income or the expected margin for September, the milk would have been $15.34 on the Board of Trade. That was the expected. And the feed, the USDA ratio is a half bushel of corn and 4 pounds of soybean meal. The price of corn and soybean meal and times the amounts would have brought the feed cost to about $2.81. So that would have made an expected gross margin or income over feed cost of $12.55. So that was a projection, the expectation, kind of whatever you want to call it. And then when you get through that period, you come back, and this would have been in October. We would have had the numbers for the October purchase, the end of September, which was the end of the period, the insurance period, And the actual turned out to be, well, the milk was $12.08 a hundred, which was a couple bucks a hundred less than what the projected was. The feed, again, the same amounts of feed to produce a hundredweight of milk. The prices varied. The feed cost was $2.24, so the actual gross margin was $9.84. So then we would compare that to the expected gross margin of $12.55, and the insurance indemnity at zero deductible would have been $2.71 per hundred. So each hundredweight of milk that I would have enrolled back for that insurance period for the month during the month of September I would have got paid $2.71 a hundred. If the actual margin had been $14, why, I would have got to keep the $14. It's not a matter where it's at, if it breaks a certain point, I have to give some more back. It's just a straightforward lock-in on income over feed cost. There are 12 opportunities to enroll the last business Friday of each month and the following day. Have to do it while the market's closed. And during each period, there is a 10-month insurance period. So the month that I enroll, there's a month lag, and then we begin counting. And so that month plus the next 9 would be the insurance period, and I can choose to insure any or all months, and I can choose the amount of production I want to insure any or all months. And I can go as low as 100 weight of milk, so I can kind of get a feel for the program and over time test it out to see, hey, is this the kind of thing that would work for me that I would consider really making an investment in to provide a meaningful safety net on my business. In conclusion, the income over feed cost insurance, or dairy gross margins, what it is intended to do is help a producer survive a period when a disaster, when the income over feed cost is really a wreck, to help you through those periods so that you can stay in business until it becomes profitable. And the ratings on this program, the premium ratings and so forth, are projected that over time the grower will get all or more than all of his money back in the program. For more information about the program, at your own time and pace, you can go to the web pages. There's a number of very good resources. The one dealing with understanding milk marketing is a particularly good one by the University of Wisconsin. Lets you look back over your shoulder kind of and see what prices of milk and feed have done and what their income over feed cost would have been, as well as they make some projections for the future. So that'd be a nice warm-up to think about the program before you contact your insurance agent to think about it in earnest and get some real numbers.